Let's look at the different decisions that management makes and what is the proper cost classification that needs to be done in order to make a good decision. In this first one, we have the decision is to determine the amount of cost of goods sold. If you recall back in module 4, we talked about how you had to value your inventory on the balance sheet. In other words, we had to determine what were product costs versus period costs. This was for financial reporting only. It was not for managerial purposes, but the idea is that for your financial statements, we had to determine the amount of cost of goods sold that would be on the income statement, and we had to determine the amount of inventory on the balance sheet. So as far as the cost classification, determining whether something is a period cost inventory helps you to determine whether or how much is cost of goods sold. If you recall, period costs are the costs for selling, general, and administrative expenses, and those are expensed in the period they are incurred, rather than being part of the cost of a product and then later expensed when the goods are sold. So the answer to the first is product versus period in order to help to determine cost of goods sold on the income statement. As for number 2, to determine the number of products to sell to break even, if you can recall from the module 5, we did break-even analysis, which required us figuring out what the contribution margin per unit was. And once you figured that out, if you divide it by your fixed cost, that would determine the number of units that you would need to make and sell to just cover your fixed cost, i.e. no profit, zero profit. Just to refresh your memory, contribution margin, again, is your sales, which is your price times your quantity, minus your variable cost, which is your variable cost per unit times the quantity. So the quantity is determined, the number is determined when you take your contribution margin per unit and divide it by your fixed costs. The only way we can do a break-even analysis is then to make the split between the fixed, variable versus fixed. So our answer is the middle, variable versus fixed. Whether to outsource or to make or provide, to make the good or provide a service for ourselves requires us to look only at incremental costs or revenues, costs, or profits that are relevant to the decision. So in other words, you want to look at only the things that will change as a result of the different alternatives. And what's difficult about doing the incremental analysis is that it's hard to know, or you have to be very careful about costs that are irrelevant, i.e. sunk costs, i.e. the costs that do not change as a result of the different alternatives. So in this one, your answer would be the relevant versus irrelevant. Arguably, you would want to know also, though, your variable versus fixed, but this is more relevant to this type of decision.